I welcome you all in this very important webinar, which is being scheduled by Taxmann on a very, very important and complex topic, I would say, that is Ind AS 117. If we all who are present here belong to, I would say, financial reporting teams or financial reporting, domain or industry itself, we must be aware about Ind AS because Indian accounting standards are converged version of IFRS, and at the first time they were made applicable in 2016, but there was an exception which was given to banks and insurance companies, and since then we as an Indian investors or Indian experts or Indian companies, we were waiting for this implementation being happening on insurance companies and bank, and it has happened since the MC has notified Ind AS 117. So now Ind AS 117 is applicable. So let me why we chose the topic's name as transforming insurance reporting, because I would say it is not implementation of Ind AS 117. It would mean that Indian accounting standards are applicable on an insurance company. So people are often, since 12th of August we are discussing, previously also we used to discuss when often we meet folks from insurance industry. We do work with some of insurance companies around the other aspects of annual reports, because Ind AS was not there in place before 12th of August. But there was one common thought which was there in everybody's mind, that sooner or later it is going to come. And then the subsequent thought, or the thought which was following it, was that we are still not ready for this transformation. And why we are not ready, this is, I think, something which is to be introspected between us or within us, because the buzz of Ind AS 117 or Ind AS being implemented on the insurance companies and bank is since, I think, probably since last 4 5 years. The buzz is there in the market. Exposure draft was introduced by ICAI in 2018, I would say. Then it was passed on to NFRA. Then NFRA has given its recommendations to Minister of Corporate Affairs. Then it moved on to IRDA and so on. Now the insurance contract Ind AS 117 is notified from 12th of August. Maybe you must have seen online also, when this notification came, there were some posts that it is kind of a midnight shocker. It is kind of a mid-year shocker for insurance companies. What will happen to the insurance companies? The problem can be dissected in two parts. One part is that what will be the implication on insurance companies which are listed, and the other part can be attributed to the insurance companies which are not listed. Why I am saying so? Reason being, see, if you're sitting on 12th of August, you are following the deadline of half yearly results which are going to come after the completion of first 6 months, that is 30th September. So effectively, if I take time frame with if keeping this in mind, that this is not deferred from present scenario, it is applicable from the date it is notified. It says that it is applicable from 1st April 2024 itself. So if it is not deferred, if the regulator, which has come to our knowledge, we had a lot of discussions after this Ind AS being notified with some of the officials of IRDA, also some of the listed entities, some of the insurance companies from journal and insurance space both. So the common discussion which was going on was that they have represented, for if you talk about general insurance companies, the GI Council has also represented to IRDA that they need some time to implement this. Maybe probably a gradual implementation. Probably they want a timeline that it should be made applicable from 1st April 2025. But having said all these things, if it doesn't happen, what will happen? Sky is not going to fall. But what will happen when you publish your next half yearly or quarterly result? And if you are a listed insurance company, you are bound to convert or present your accounts in compliance with Indian accounting standards. And when I say Indian accounting standards, see, 117 has its own implications. Maybe the space will not change in terms of complex working for general insurance companies, but in terms of life insurance companies, when the size or when the tenure of the contract is very, very long, the period is very long, certain things are going to change in a drastic way, and certain hustle and bustle is required to keep things in place, because the systems are required to be upgraded. Technology is required to be upgraded. Probably they are doing it as of now. But if you are a listed insurance company, why people were calling it as midnight shocker, or it is in mid-year shocker? Because for you to take each and everything in place, you have probably 85 to 90 days clear period. Let me take you to the implementation of IFRS 17. In this backdrop, IFRS 17 was made applicable from 1st January 2023. So we have seen, from global perspective, 3 clear half-year cycles of post implementation era. But when you see, I'll share some snippets of report of LOPA, which is an association of European Insurance Association kind of thing. It says that what major data points or what major issues which insurance companies were facing while implementing this in IFRS 17. One of those changes was the same which I am talking about, that when the cutoff date came, when it was the time that post implementation, you have to present your results, you have to reinstate the opening balance sheet, and you need to bring out certain changes. In that case, most of the companies have given their results at the last juncture of time. See, if 14th of November in our case, if we are an Indian listed entity, you have 45 days after the end of quarter or after the end of half year, as the case may be. So probably 14 November is the date which an insurance company which is listed should have an look at, because it is the date by which you need to publish your results, and you need to bring in certain things in place also. Why it is not just Ind AS 117? We have already seen 109, 116. These are one of few complex Indian accounting standards. And if you see, compare specifically regulated entities, I will take 2, 3, 4 minutes on what is the present reporting structure, and then we move on to what all changes broadly we will discuss, because we just have 1 hour. So probably I would like to take questions at the end of session, so we can continue in the flow of the session. So if you talk about specifically regulated entities means NBFCs or banks which are regulated by RBI, and insurance company which are regulated by IRDA. So these are two of its kind specifically regulated entities. In these companies or in these type of entities cases, the regulation, the kind of framework which is there for financial reporting elsewise also will be will be taken care by RBI, will be taken care by IRDA. So in these companies cases, banks were more or less, I would say, in terms of preparedness of facing the implementation of Ind AS, banks were more, I would say, prepared. Insurance companies were not in that sense were prepared to that extent. Though a steering committee has already been formed in all of the insurance companies as per the instruction, as per the guidelines of IRDA, but still I would say insurance companies were the one which were looking at a not too early but not too late, but they were looking at a timeline of maybe 1st April 2025, and that's why this has come as a surprise to many of them. So why I said that it is not transformation from IFRS Ind AS 104, which was never made applicable in insurance companies, which was notified, but it was not made applicable. It is a transformation of traditional gap, that is maybe accounting standards, you would say, or IRDA's regulation to Indian accounting standards. With 117, you see implementation of Ind AS 109, you see implementation of Ind AS 19, you see implementation of Ind AS 116, you see implementation of Ind AS 16. Because when you see that notification of 70 pages, which has been published by MCA, you will see that MCA specifically mentioned that in various other Ind AS what clauses will be changed, how the effect of implementation or notification of Ind AS 117 will be given. So it is a transformation from the traditional reporting practices, traditional gap to in Ind AS. It is not transformation, or it is not just about 117. It is about looking at a broader picture from a holistic view. Why I am saying so? See, broadly, if you dissect the insurance company's financials, you will there can be two type of results. There can be two type of incomes. One is from insurance premium, which is the major, or which is the core business of these companies, and the other will be from investment. So till now, there is no such bifurcation, no such dissection which is there, that how the result of insurance company will will incorporate these things. It was an kind of a consolidated result, which was published as per the IRDA presentation of financial statement guidelines 2002. It was notified in 2002, and it has been amended to a certain extent, but still it was awaiting a major change, which has come in the form of Ind AS 117. So investment is one of the major factors. And if you take into consideration of implementation of 117 or Ind AS, you will see 109 is also going to play a major role. It is going to play a major role in how the financial statements of insurance companies will take a different shape. So there was no OCI before. There was no fair value concept before. There was concept of I would say your concept of actuary, which was there, because if you talk about insurance companies or insurance sector, it is largely dependent upon actuarial valuations, assumptions, etc. And when you talk about life insurance companies, I would say to a greater extent, the results or the whole reporting framework is dependent upon the actual assumptions and valuations. So, and I can say that we have discussed this in our previous session also with ICAI, that no two actuaries can come on the same page. So there is a very very sizable I would say space for subjectivity. But having said all these things, what is going to change? What is going to change, and why this change was required? So as of now, as I said, that IRDA regulations are applicable on insurance companies, and they are preparing the financial statements. There are few Ind AS regarding which a certain note is required to be given as per the format. Otherwise, not all accounting standards are applicable on insurance companies. Not all accounting standards are applicable on insurance companies. Specific notes are given. Then the financial statements are prepared in line with the IRDA guidelines. And you will be surprised to know that if there is a nil schedule, for example, if you go back after this session and you see download annual reports of 5-7 listed entities, insurance entities, you will see if there is a schedule. I think, if I'm not wrong, schedule 8 or 9, which pertains to loans. So even if it is nil, companies were publishing this because they thought, and they are under such impression that they cannot deviate with the format given by the regulator. The answer to which is correct, but we need to understand these regulation in a very holistic manner. That when you talk about income tax, you always talk about taking harmonious interpretation. So why don't we do the same in when it comes about financial reporting framework? It should be, and it can be done in the same way. Like, if you see, just diluting a little bit from the topic, if you see in recent times, SEBI LODR regulations are changing, quite frequently, quite often. Quite often, I would say twice or thrice in a week, we are looking at new notifications, new consultation papers by SEBI, and 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 then such of back and forth working on those consultation papers, then a new regulation or amendment comes into play. Like the concept of materiality was introduced last year in the June 2023 amendments of SEBI LODR, which said that there will be no subjectivity when it comes about disclosing of material events and information. So there was very you and cry and talk that how do I assess this? How do I see that? And I always said from the beginning that you need to take the harmonious interpretation out of these regulations. You cannot start doing disclosing, disseminating each and everything to the exchange, to the regulator, because then the materiality will be taken over by triviality. And then the whole very purpose of these disclosures will be taken away. You talk about Ind AS 117. It is about insurance contracts. We need to have an holistic reading of 117. And I would say if you want to gain comprehensive knowledge of 117 or insurance contracts per se, you need to read IFRS 17, because there is no such illustrative examples which are given with this notification, but you see basis of conclusions and illustrative examples with the IFRS 17 study material, which is, I would say, more comprehensive nature from understanding perspective, and from the perspective that somebody is reading who is quite new to this concept. So having said all these things, long story short, Ind AS 117 is not not it is not a mere change in terms of financial reporting. It is a major change in terms of how the results of insurance companies will be communicated to the stakeholder. Stakeholder communication has changed. The way you assess, the way you analyze, be as an investor, be as an analyst, be as an expert, the whole scenario is going to change. And there is ample opportunities for chartered accountants, I would say, other professional fellows in this field, because this is a relatively new field. Probably the bigger or almost all the insurance companies has already started the working towards implementation. After formation of steering committee, they are having regular meetings, etc. Maybe the implementation has already been stressed to the stress to the last stage. But post implementation, there will be support which will be required by those insurance companies. There will be quality review related assignments which will be there, because since it is a first time implementation, the chances of there being any error in the process, the system, or the disclosures cannot be denied with. So in that case, there will be huge opportunities for all of us as professionals. So taking straightforward you guys to why this change was required, and then we'll discuss what are the major changes, what are the major differences which has come in Ind AS 117 from previous gap. As we already said, there were diverse financial reports. The lack of transparency and relevance was there. It can be clubbed with diverse financial reports because, if you talk about inter-segmental comparability, if you see the results of an insurance company, which is a life insurance company, and which is a general insurance company, you will not be able to compare as of now in the present reporting structure. If you want to compare a result of an insurance company, because it is a service provider, with other service provider companies, you will not be able to do, because the top line, the bottom line, I would say, the turnover, the kind of presentation is which is being made by these companies as per the IRDA regulations is totally different. There is no matching concept, friends, as of now in the present reporting framework in case of insurance companies. And let me simplify or tell you what is matching concept. Matching concept is that the premium is allocated or is recognized based on the number of days for which the premium is received, or maybe on a 50-50 approach, that you recognize 50% premium upfront and you can recognize 50% premium after or at the time of completion of that particular policy. But all the expenses, be it your be it your insurance agent's commission, be it your other sort of expenses for procuring business, for other expenses, they are all upfronted. So there is no matching concept as such in case of insurance company. Limitation of previous standard, this I think point is not relevant much, because 104 was notified and people were waiting that it will be made applicable, but it was never made applicable. So hence it is not relevant. It doesn't make any relevance in terms of practical life. It may have relevance in terms of theoretical understanding or reading, but not in practical sense. It doesn't have any relevance. Inconsistent accounting practices, as we have already discussed, and lack of transparency and relevance. See, the ultimate purpose of publishing financial results is can be dissected into two parts. One is that any company have its own responsibility towards the regulators or towards the environment in which it is operating, and second, it has its own responsibility towards the stakeholders, investors, consumers also. So if you take example, I am a chartered accountant. I take my example that, like me, there are other thousands of chartered accountants or professionals. And if you ask me if I'm not related or if I'm not connected to this particular domain, if you ask me that how do I, compare, how do I analyze an insurance company's result, the answer will be no. I'm not able to analyze. I'm not able to extract certain KPIs out of that, because this is so complex. It is not common. It is in specifically regulated sector. It has separate set of regulations which were introduced at the first time in 2002. They certainly need change, and there is no consistency. As expert also, if you talk about a chartered accountant journey, other than reading the insurance companies chapter, I think at my time it was in PE2. Otherwise, we don't often read much about these things, because again, people see that it is not relevant to each and everybody. But these were the main reasons. These were the main points which were which were forcing the this transition from traditional gap to Ind AS for insurance companies, so that a uniformity, a transparency, and a relevance can be drawn between various intersegmental companies' results. There will be more consistency. There will be more enhanced, or I would say transparent communication to the investor per se, and they will be able to read and understand the results also. Take one such example. If you take any insurance company's balance sheet or profit and loss account as of now, and let me ask you a question, that what is the turnover in case of an insurance company? I'm continuing with the presentation, but I'm putting up a question that in case of an insurance company, what is considered to be the turnover? This is a question for all of you who are present. So if you take present reporting structure of an insurance company, you would see that there is no transparency or there is no consistency, I would say. But for an insurance company, investment portion is something which is very significant. If I am getting the funds, it works like that you are giving premium, I am giving premium, somebody else is giving premium, and out of pool that is being created by the insurance companies, if any loss has occurred, if any loss of life has occurred, the compensation is being given to the policy holder. So it works like that. Out of a pool it is given, but the rest of pool is invested into various type of securities. And that's why I say that for an insurance company, the insurance results or insurance service results are equally important, in line with the investment results also. So previously there was no such bifurcation, dissection, but when you see post implementation of Ind AS 117, you can write it down also for your understanding, though the presentation will be shared, that you will see two type of results in the profit and loss account of an insurance company. One is insurance service results, the other is investment results. Meaning by which, for an investor, it is giving clearer picture that what type of returns your insurance company is making on the investment that it has made. what type of premium income it has generated over the year. Though in insurance sector the pricing of any product has to be decided in convenience, or in acceptance, or in consulting with the IRDA. It cannot be done in isolation. IRDA has to agree on pricing. Actuaries also play a very vital role in pricing any product. But in all cases, it will be better from investors' perspective that I'm able to see the investment results and insurance service results separately, and better to make out a case that whether I want to invest into this company or not. So they were one major, part which was there for insurance companies. It is called management report. Management reports were introduced in 2002. It is part of present financial reporting framework of insurance companies, which says there was certain 13, 14 pointers which are required to be presented in a certain way specific to your company. But you see what has happened, that companies are presenting it in a very journal way. Companies are presenting it for the sake of compliance with the IRDA regulation. But IRDA has clearly stated in its guidance note, also when it was made applicable many years back, that it has to be company specific, like your MD&A. If any of us work around listed entities, or we are investing into listed entities, we will be aware of the word MD&A. MD&A is management discussion analysis and management report, is kind of the same thing which insurance regulator has thought for insurance companies, that the insurance companies will provide a better communication to the stakeholders. So these were the main points due to which this change was required. Now let us come to a point: what is the applicability, or what is the scope of Ind AS 117? So let me tell you in brief that Ind AS 117 is applicable on insurance contracts. Insurance contract is basically kind of a contract between a policy holder and an insurer, or between two parties, I would say, in which one party agrees to take the burden of risk of other party in lieu of a certain amount. So the party which is taking the risk, which is absorbing the risk, is the insurer, and the party which is renouncing the risk is the policy holder. So it is applicable on insurance contracts. Then it is applicable on reinsurance contracts also. Again, see, I also understand that these webinars are often termed as boring ones, often termed as one-way communication. But let's make it very interactive. So if you don't ask questions, or if you don't reply to questions, you will not be able to understand the nitty-gritties of 117. I'm not saying that you will be able to understand in 1 hour, but at least grab some journal knowledge. So if you go back and if you read the standard, if you read other study materials, you will be able to correlate that what has been said in this session is coming out in the theoretical part also. So reinsurance contracts, basically, I would say that I am an insurer. There may be a case that I have assumed the risk to a certain level, which internally I think that it is not justifiable to my capital, adequacy. So in that case, what I will do, I will ask other insurance company, which can be a specific reinsurer, or which can be a company which is doing insurance as well as reinsurance also. So in both cases, a insurer will approach a reinsurer that you cede my risk. Okay, you cede my risk, and in lieu of that, that person will pay, that insurance company which is transferring its risk to a reinsurer will pay in premium to the ceding company, which is the insuring company, and the reinsurer will pay commission also on that the part which is being given for reinsurance to the reinsurance company. Generally, there are specific reinsurance companies which are doing it, which have a larger pool of funds or resources with them, which have access to huge capital. Also, there may be a case, for example, if you take example of future generally, so they are good into fire insurance, say, and they have a good pool, and they have set internal understanding that in this case they have sufficient capital education, they can take the insurer role also. So maybe for not all general insurance, but they can they can play the role of reinsurer for case of fire insurances and other general insurance company. Say take an example of Star Health or other general insurance company might put some portion for reinsurance to that other entity, which is the seeding company. Third type of contract uh, on which that Ind AS 117 is applicable, it is investment contract with discretionary participation feature. What is investment contract with discretionary participation feature? Means that any insurance contract which has two, I would say, attributes attached to it. One such attribute is certainly going to be the risk assuming role. The other attribute will be kind of a investment benefit, I would say. For example, in an insurance policy, take in a life insurance policy, or in a policy which works on annuity also, I would say that you give me 10 lakh rupees one time, or you give me 2 lakh rupees in 5 installments, and after 21 years, if you if something happens to your life, I'm going to compensate you for a certain amount which is fixed at the time of, uh, which is fixed at the time of, I would say, insurance contract or the initial contract being taken place, and uh, and along with that, if something happens to you or not, in other cases also, you'll get a certain amount, say a lakh rupee a month for 10 years or 20 years. So in this case, these contracts will be called investment contracts with discretionary participation feature, which means that in addition to a guaranteed amount, supplementary amount is also there as an additional benefit for the policyholder, and which represent a significant portion of the total contractual benefits of that particular policy. So these are the three types of contracts on which Ind AS 117 is applicable. So, if you talk about reinsurance contract, because it is in front of my eyes, and I would not, stop myself of saying that previously you would have seen, if you would have seen any insurance company's result, you would have seen that the reinsurance results were used to be presented on net of basis, that reinsurance, ceded or reinsurance ceded or reinsurance taken will were netted off, and a net of result will was presented till date. After implementation of 117 or post implementation of 117, this reinsurance contracts results presentation will change, and you will have to segregate these two items. You will have to show separately the kind of the premium, that you have assumed, received as a seeding company, and that the reinsurance portion that you have given to other reinsurer for the purpose of securing or mitigating the extra risk that you feel internally that is there in front of you, seeing the present pool of your risk exposure. So this is in terms of reinsurance contract. And one more thing which is not a old concept, but cohorts are also introduced. So the level of aggregation after implementation of 117 has will change to a greater extent. There was no significant level of aggregation in terms of previous or present reporting framework. But when you talk about 117, when you talk about IFRS 17, you will see the level of aggregation getting to a certain new level, in which, first of all, I need to dissect my insurance contract into three parts. One is one is one is, for example, say I'm doing in various kind of general insurance. So first, what I will do, pool. I will do pooling of car insurance separately, uh, fire insurance separately, motor insurance separately, maybe single premium annuity type of insurance separately. I need to, basically, it says that the kind of insurance contract or group of insurance contract which has the similar nature of similar specifications or similar attributes should be clubbed in a single group, and this is the first level of aggregation. For example, you have group health insurance contract in a single set of group. Then you need to dissect it further also. You need to dissect it further if it is a onerous contract or not. What is onerous contract? Onerous contract is a contract for which at initial recognition itself the company is of the opinion or of the view that it is going to be loss making contracts. For example, it is not true in every sense, but for example, when COVID happened, previously or at the time of COVID, insurance policies were issued. So probably the companies had that thought in mind that if any insurance policy is issued during this time juncture, it can be a loss making contract, because the probability of that person who is taking that insurance policy having any disease is much higher than the other case. So it can be an example. I'm not saying it is the case, but it can be an example of honest contracts. Then then the kind of then there can be a subjectivity also, that at initial recognition the company is not able to determine that whether the insurance contract will be a loss making contract or will be a profit making contract. It can be on both sides, and then the remaining contracts come into place. Then there is other third level of segregation or aggregation, I would say, which is there, that if out of these specified groups and aggregations that I've done till now, if any any insurance contract or group of contracts which are falling within the criteria of 12 months, then they will be clubbed in a single group that is called annual cohort. And if the insurance contract is is going to be for next 2, 3, 4 or many years, then it is going to be clubbed in a separate group, that is 12 months or less, 12 months or less, and 12 more than 12 months. These are the basic two different segregations which are being done. So you can understand the kind of aggregation, or the kind of specificity which has been brought in by implementation of 117. So there do do application of your implementation of 117 means that it is applicable on all type of contracts in which the risk is mitigated by one party to the other party. The answer is no. See, it is again a quite kind of a disputed matter, kind of a matter which needs more deliberation. I can say maybe, I can say might be, but I cannot say it will be. The reason being, so these 5 pointers are given in the standard itself, but it also comes with certain attest conditions also. But having said these things, I cannot say specifically that whether insurance contract 117 Ind AS will be applicable to any other company which is not an insurance company, because in India insurance is a regulated business. In India, insurance is a regulated business, and it is being taken care by IRDA, and you need approval to act as an insurance company. So let's have a look at these 5 points. Product warranties, it is very common. If you go and buy any sort of electronic item, be it your cell phone, be it your laptop, in which you might be watching this webinar on YouTube or Zoom, I would say. So product warranties, often companies give product warranties with the sale of products. So will it be covered under 117? The answer is no. There are separate provisions in 115 and Ind AS 17, which 37, I would, sorry, which covers these regulations. Employee benefits plays an important role. How the insurance company's result will shape into. But whether you can say that retirement benefits such as termination benefits, gratuity, etc., will fall under the ambit of 117, or you might say ESOPs, etc., share-based payment. The answer is no. Then some non-financial items such as license fees, leases, etc., lease agreements also will fall under the ambit of 117, the answer is again no. If any contingent consideration, you go back to 103 business combination, and you, I think, if I'm not wrong, you, these para 64, I would say, you read para 64 and you see about contingent consideration. So if there is any contingent consideration which is payable on happening of a certain event in case of business combination, will this mean that a certain risk is being mitigated by the company which is taking over, and it need to apply 117? The answer is no. Then credit card contracts, or I would say debit card contracts also. So this is very common. If you are holding, I assume that almost all of us will be having debit cards, and probably most of us will be having credit cards also. So there is an embedded feature with a debit card or credit card that it gives you a certain insurance coverage. It is being publicized as a benefit also. If you take a certain card, that you will be covered for accidental insurance up to 5 lakh rupees, or for a personal health, or sorry, personal life for 10 lakh rupees, etc. So does it mean that a company which is issuing a credit card, which is predominantly a banking company or a non-financial company, non-banking, non-finance, non-banking financial company, NBFC, they will be falling under the ambit of Ind AS 117 insurance contract, or they are entering into an insurance contract? See, I would say the plain answer is no, because in India there is no chance that any company can do an insurance business without getting registered with IRDA. But if the insurance risk, it can influence the pricing of that particular individual product. For example, if I have a MX Platinum travel card or HDFC's Biz Black Diner card, and it says that if you take X benefit of insurance or coverage, then uh, then in that case, in that case, the annual fees will be, say, 15,000 rupees. And if you don't take those benefits, then the annual fees will be, say, 5,000 rupees. So there is a substantial difference between the pricing of this individual product based on the insurance risk coverage. So in that case, they might fall, but in that case also, you need to segregate the insurance portion out of it. You need to segregate the other portion out of it, and they have to be seen differently. They have to be seen in isolation. On insurance portion, the portion which is there to cover the risk coverage, on that insurance portion, 117 will be made applicable, and the investment part, 117 will not be made applicable, 109 will be applicable. So this will probably sum up. I'd not say in detail, but what are the major changes in new accounting standard 117 and IFRS 17, or I would say previously done reporting framework? One is the measurement approach. So measurement approach, with the implementation of 117, there is a building block approach, or PPA, which was there in place also. That is premium allocation approach. It is being introduced. So I would say there was no such concept of discounting or estimation of future cash flows adjusted with the discounting rate, you know which uh, which take into factor all the risk matrices attached to the particular time period of the particular contract. But now, after implementation of 117, you can call it GMM also, General Measurement Model. So this approach, building block approach, is being implemented. So as an insurance company also, do I have a option, to follow different sort of approach? So I would say, generally for the short tail contracts, which have the contract life of smaller period, maybe 12 months less, or maybe a year or so, 2 years. PPA approach is preferred, and it is followed. It is allowed also, but if every year of coverage, you need to assess whether the group of insurance contracts are eligible to be covered under PPA approach. Then we have already discussed about presentation of financial statement. Post 117, there will be more detailed and desegregated information, which will be passed on to stakeholders in the financial statement. For example, I've already said that the insurance service results will be dissected from the investment results. Insurance service expenses will be shown separately. For example, the investment income will come differently. For example, the reinsurance contracts, which were till now were being shown as on the net of basis, will be shown separately. For example, in case of balance sheet, liability, LIC and LRC, that is liability for remaining coverage and liability for incurred claims, etc., will be shown in the liability side, and maybe probably in the case of reinsurer, the ARC and AIC, that is asset remaining coverage and asset for incurred claims, will be shown on the asset side of the balance sheet. So these were some of the major changes which you will see in a balance sheet or profit and loss statement of an insurance company. One such major change, the question which I've asked in the beginning also, what is the turnover in case of an insurance company? So for the case of insurance company, the turnover is treated as GWP, that is gross written premium. So gross written premium is taken as the turnover for the insurance company. Till now, it is being shown in the notes to accounts, but post that implementation of 117, it will be shown in the main financial results. So the turnover, the top line of that particular entity will change. Probably it is going to have a very big impact how we look at at the insurance contracts, insurance companies' results. Then recognition of contracts. So previously there was no such segregation, but post implementation 117, as we discussed, the applicability, it is applicable on honest contracts, it is applicable on insurance contracts, it is applicable on the insurance contracts also. So the kind of you know so the kind of changes which will be there in recognition measurement are also going to be very used. For an honest contract, you need to decide at the inception itself that whether it is a loss making contract, then you need to account for that, and if it is not a loss making contract, then it is fine. But in the traditional reporting framework, you had an option to defer that loss as and when the loss occurs. So maybe since the role of actuaries are too much in insurance sector, you can say the accrual concept has come in its lighter or practical sense in implementation for insurance companies. Then the discount rates I've already mentioned. If you take the GMM or the building block approach, so there was no such estimation discounting of future cash flows with adjusting risk factors for financial as well as non-financial factors also. If you will estimate the future cash flows of any group of insurance contracts, you will account for you will discount the future cash flows, then you will account for the risk adjusted changes, risk adjustment for non-financial portion also. So there was no concept of discount rates as such in Ind AS 117, pre Ind AS 117, but now the discount rates will come into play. Now the question will be, what will be a discount rate? That is, can I use XYZ any banking borrowing rate? The answer is no. You need to use comparable applicable rate of return or rate of risk in similar to a particular group of contracts for which you are estimating. Then it has to be risk adjusted. All the risk factors are required to be factored into. Then the risk adjustment part, I already covered it with the discount rate. Then the CSM. See, contractual service margin is a new term. When it comes to my amount, what is CSM? CSM represents the unearned profit of an insurance contract. Unearned profit means that at inception, say I have a 4-year contract per se, and at the inception I am receiving say 0 rupees at the inception. I will receive 1,000 1 month, then a year, then 2 years, 3 years, and that's how I'm going to receive the whole premium of 4,000 rupees of insurance contract. So I will discount it, calculate it, the future estimated cash flows on a discount rate, which is which factors in the all the risk, etc., which is similar to the nature of kind of group of contracts that are being assessed. So in the next 4 years, at discounted rate, I'm going to earn say 2400 rupees or 3400 rupees. This becomes my CSM, and it will form part of my insurance contract liability from the day one, or the time when I account for when I receive the first premium allocation approach we have already discussed. So these were the major 7 changes which I felt that they are there in Ind AS 117 when compared to traditional accounting standards. I'll not touch upon these methods in detail because we are running short of time. We are already standing on 5:53. So let me take you to some other important things. What is LRC? Liability for remaining coverage represent the present value of future cash flows related to the remaining coverage period of an insurance contract, considering the current estimates and assumptions. For example, I've issued a 3-year policy, say in case of a general insurance company, a 3-year car policy. I have, uh, you know, 1 year has elapsed by. So in that case, I have 2 more years of insurance coverage, which I need to extend to the policy holder. So in that case, the future assumptions in that case, the discount rates, various factors such as mortality, morbidity, and lapse rate will be of very much significance, and it will form. You will see these LRC, LIC, and ARC and AIC coming in the balance sheets of these insurance companies post implementation. If it happens and it is not deferred, you will see it in the first half year result post September this year only. So this is also very important. Then LRC we have discussed, LIC we have discussed, risk adjustment and discounting we have discussed. This we have already discussed, that what was the regulatory mindset with which this change has been brought into place: transferability, comparability, improved risk management, and increased focus on disclosure. One such question which is there in my mind: last year, the concept of material accounting policies came into play when Ind AS 117 was sorry 10 Ind AS Ind AS 1 was amended and Para 117 was introduced, meaning by which, if I feel that the same sort of concept will be applicable, because in this one is also amended to factor in the impact of 117. Let's see how it come out, how the IRDA provides its guidance. Till now, what we have learned, or what has come to our knowledge, is that IRDA is saying that do it on the basis on which the global companies or the global regions have done it for implementation of IFRS 17. If it happens, then the concept of material accounting policy will also play a very significant role in terms of disclosures. So whatever changes even other regulators are also making, be it SEBI, be it ICAI, be it RBI, be it IRDA, 2-3 things are very important: transparency, governance, asymmetry of information, and improved disclosures. So these 2, 3, 4 things are the main pillars or are drivers of all these changes which are coming into these regulations. Some challenges which insurance company may face: product pricing challenges, regulatory guidance is required, because as of now, all these companies are, I don't know they are going in what direction, but they are following what their parent or their MNC partners have done. They are almost ready, or they are working for fast implementation of say Ind AS 117, but yet a guidance or how this will be implemented, what data points or KPIs will change, a proper guidance is required, which is due from IRDA side. Profitability implications, which we may have seen, because if you take the ILOPAs, I will take you straight to the main challenges that that the insurance companies have faced post implementation of IFRS 17. One is that there was a negative impact on shareholders' equity in case of, if you compare the balance sheets post 2023 and after implementation of IFRS 17. There was change impact on KPIs also. Previously, what KPIs which were used to measure, or which was used to analyze or assess the results of insurance companies, have drastically changed. The data requirement, the system requirement, the policy changes, the process changes, because it is not that easy that you drive a change of implementation or transition of 117 or 17 to and push to an organization. There has to be a backdrop working of changes in your internal controls, policies, technologies to a larger extent. A new CSM engine is required to be put into place. Accounting policy choices, actuarial models will change. So the system is not that easy. It looks complex, but with complexity comes the opportunity, I would say. As it is often said that with adversity there is an opportunity, I would say with complexity for professionals there is a clear sense of opportunity which I am seeing. Predominantly we do work around large listed entities for their annual reports, for their ESG, BRSR advisory or integrated reports. We are working with the insurance sector also. But having said this thing, being a chartered accountant, accounting standards or Indian accounting standards are close to our heart also, and we feel that there is a very large opportunities for the youngsters, for the new professionals, or the professionals which who used to work in this sector. There will be more and more assignments if we can, if we can upskill ourselves to that level, that we can provide a comprehensive support with a knowledgeable team to these insurance companies in a righteous way. So these were the major challenges, implementation challenges we have already discussed. Then what are the benefits we have already discussed? Investor relation enhancement is something which is very important. It will build the trust, it will build the comparability. The people will be able, investors will be able to compare it, intersegment as well as cross industry also. Then with these words, because we are running short of time, it may have impact on other industries also, such as transportation, construction, hospitality, manufacturing, and other industries also. With these words, I will put my deliberation to end today, because we had just 1 hour of time to deliberate upon this, which the topic I would request the organizers to organize a certain webinar for 2-3 hours. I would say 2.5 an hour, because this is a very vast topic and interesting one also. And if you start discussing each and everything, it will certainly take time. So with these words, thank you all for joining us today evening to attend this very important webinar, probably the second of its kind webinar on insurance contracts. Do join us for the future such endeavors with Taxmann, or otherwise also you can connect with me on LinkedIn if you have any queries. And if you are not able to ask today, you can directly ping me on LinkedIn, or you can email me also. This presentation I will share it with the organization. They'll mail you post this session. Over to